same. That backstage area, that's a VIP Zoom room we've set up, is a place where you can network and talk to people and look for opportunities to collaborate. I think it's well worth a few minutes of your time, regardless of how busy your day is. With that, I am thrilled to introduce I'll introduce our moderator, and then I'll let him introduce the rest of the great panel. But we have just a phenomenal panel coming up talking about crowdfunding, and our moderator today is Bill Houston. Bill and I have become dear friends. We've worked closely on a variety of things and continue to do so. But Bill and I met nearly a decade ago at a crowdfunding conference in LA and have been friends ever since. Bill is the head at CrowdMax. He's done all kinds of consulting projects. He's a passionate activist and doing some amazing things. I'll let Bill tell you a little bit more about himself, but just know Bill's the real deal. Bill, take it away.
Thank you, Devin. I definitely appreciate all the hard work that you've done to put this show together. Really, really honored to be moderating this terrific panel. So you won't hear a lot from me because this panel is going to be really, really powerful. They're going to be really good at this today. So I'm the founder of CrowdMax Consulting and also the co-founder and executive director for the Community Finance Academy. And the reason I mentioned the Community Finance Academy is because one of the things that we're doing is we're actually reaching out to train people, what we call financial activists. And that's going to fit perfectly with what we're going to talk about today. So what we're going to talk about today is from the crowd to the clouds. When we think about traditional VC funding, it's a closed loop, and it doesn't really scale well in this impact area of green tech and green finance. So today, I have a powerful, powerful panel. And what we're going to talk about is shifting the purse, the power of the purse from centralized institution to the global crowd to accelerate this climate change. So I'm going to ask each of the panelists to introduce themselves with their name, their title, and their specific climate superpower. You want to start, Jackie, since you're kind of first on the screen there?
Sure. Hello, everyone. Good afternoon, good morning, depending on where you are. My name is Jackie Logan, and I co-founded Raise Green, a crowdfunding portal dedicated to climate solutions. And about a year ago, we were acquired by Honeycomb Credit, and now we continue the journey there. My day-to-day is about working with folks that are looking to raise capital in the climate space and opening up to the general public to invest. I look forward to the conversation today.
All right, Will.
Hello, everybody. I'm Will Wiseman, CEO and co-founder of Climatize. Climatize is a regulation crowdfunding portal specializing in renewable energy assets. You could think solar, battery storage, energy efficiency, and EV charging stations. To date, we've hosted 32 projects on the platform and are really making it so that anybody can become an active stakeholder in the energy transition. We were inspired by seeing the global climate strikes back in 2019, in which 7.5 million people took to the streets to demand larger action on climate change. And we saw a breakdown between ultimately how people had that pent up demand for actually tangible climate action and ultimately the tools that they had at their disposal. And so we see crowdfunding as a great channel for enabling the everyday person to essentially invest in the things that they believe in. So with that, pass it off to Konstantin.
Thank you, Bill. Hello, everyone from Europe. I'm joining from Europe. My name is Konstantin Boyko. I'm the CEO and co-founder of two businesses connected to crowdfunding. One is called LenderKit. There we build technology, white label software for crowdfunding platforms. And another is Crowdspace, where we collect information on various crowdfunding platforms all over the globe. and organize and categorize them. And that, of course, includes platforms focusing and working with green energy projects, solar projects, and sustainability projects. And besides that, I'm also member of steering committee of Global Equity Crowdfunding Alliance, which is called GECA. So there we advocate for the global crowdfunding and cross-border crowdfunding at scale.
I am Levi Brackman, the CEO and founder of Invown, which is a funding portal. We help people raise money from crowd, as well as from accredited and non-accredited. So if you want to do Reg CF or Reg D or Reg A, you can do it on our platform. We do have currently a green deal up, but we're not only a green or climate. We really don't have any particular flavor. We're just a crowdfunding platform, and we try and make it as cost efficient as possible for the issuer to raise money from their crowd. It's interesting you ask about what the climate superpower is. I think currently my climate superpower is that I am in Florida. I live in the Northeast, and there's a huge storm coming. So my climate superpower is that I got out of the way and I'm in sunny Florida for the weekend.
Thank you, Johnny.
Yeah, Johnny Price here. I'm the president of Wefunder, which is the investment crowdfunding platform. I live here in Nashville, Tennessee, so coming at you from Nashville today.
All right, thank you, Johnny. We're neighbors. I'm just up the road in Louisville. So we're going to start here, and I'm going to start with Konstantin. And what I want to talk about, or what I want you to talk about, is the global infrastructure. What technology needs to do in order to meet this moment?
Okay. Well, I guess we need to start with the question why there should be global or cross-border crowdfunding at all, and especially in the context of climate solutions and green energy and so forth, because there are many projects in crowdfunding which by definition are local. So for example, you fund something which is in your neighborhood or in your local community, and you don't need investors from continent to actually invest in that project. At the same time, when we are talking about climate change, this is global by definition. So it means that actually by funding something in another country or another continent, you help the planet overall. So you help your community, of course, in indirect way. So from that perspective, cross-border and global definitely is important in this context. But technology is really not the main issue here, I think. Technology is ready. Technologically, it's not really a big deal to do things cross-border. What is difficult is to comply with certain local regulations, and it's even difficult when you operate in one country. But if you try to do things cross-border or even and try to raise from different platforms and combine that becomes a much more complicated challenge. At the same time, there are certain success stories. Even one of our early customers at LenderKit was a company called Charm Impact. They are still there, but they are doing a little bit different things now. But they started. It's a UK-based company. They started as a platform allowing European investors to invest in green energy projects in sub-Saharan Africa and get, first of all, interesting returns, but also they had a very interesting financial approach with blended finance. So basically the risks were a little bit limited for the investors, and that made it attractive for them to invest in those projects in Africa and not be scared about all those cross-border challenges. So they found a solution, and I think that's really a success story. At the same time, it's still, even within Europe, where now it is possible to get, within European Union, for example, it is possible to and get a license in one country and then operate in all those member states. It is still not easy to do things cross-border, and statistics actually confirm this. Less than 20% of transactions are cross-border. And the reason is that in various member states, in various European countries, the implementation of European regulation is very different. So local authorities treat things very, let's say they have their own opinion. So all in all, it makes things quite difficult when it is cross-border. So technology-wise, definitely there are solutions. There are even tokenized solutions and blockchain solutions which would allow to do things cross-border, over continent, and so forth. But first, there need to be a way to overcome those regulatory challenges. Yes, that's my take on the question.
Yeah, thank you, Konstantin. When I think about crowdfunding, the first word that comes to mind is democratization, and providing each and every person with the opportunity to become an investor and to become a part of what it is that they're doing. So my next question is going to be for Will. How can we turn renewable energy into a public utility where anyone can not just be a ratepayer, but actually be an owner?
Yeah, it's a very thoughtful question. I mean, that aligns quite closely with the work that Climatize is doing by enabling people to invest in projects with as little as $10. And that way they can actually have a stake in the energy system, which has historically been just owned and operated by regulated monopolies around, in particular in the US. You have some deregulated markets like Texas, but on the whole, regulated markets. And so being able to actually participate in energy as an asset class and get diversification by essentially looking at that as a new opportunity is something that's really compelling. Energy is one of those commodities that historically we have always used more of. And so being able to invest in energy projects in a period of time where AI is driving load growth, I think presents an interesting opportunity. Obviously, all opportunities carry risk and would encourage investors to do their research. But we have found that in this moment in time, that's really stood out to investors in terms of their opportunity. Crowdfunding really does enable people to get access to private market opportunities that historically have been kind of the realm of institutionals, banks, private equity funds. And so being able to expand access to those asset classes, this energy infrastructure, has been quite an unlock for us as a business and our clients.
Thank you, Will. This next question is going to be for you. And in the world of impact, and when we think about, how we really measure impact, preventing greenwashing, the only way I think to really do that is through data. Can you tell us a little bit what it is that you do and how you all ensure that the data is there, that when we drive this data, when we look at the data from the impact management and measurement, that it's real and it's not something that that someone is making up as marketing hype?
That's actually a challenge because there's a lot of things within this space which are unfamiliar to the average person to really understand what's going on. You have different kind of swaps, and this, you're buying potentially things in order to offset, etc. So people can't really understand necessarily. You need to be able to follow the chain all the way along, and sometimes it can be quite challenging. So we actually had to underwrite a deal which we have now on our platform at the moment, which is a green deal. And so we had this challenge because we're not necessarily experts on it. So what we found was that first of all, you need to educate yourself. So you can't just rely on what's going on, what you see there. And my recommendation is not just to rely on what you see and what has actually been attested to on the page, but actually do some actual digging on. And AI today is incredibly helpful for that. So get onto your favorite chatbot, whether it's ChatGPT or Gemini or something else, and put some of the things which maybe you don't understand about the offering through that, and ask it to explain it in plain English. and then to do some digging as well for you, because it will be able to do some additional digging for you and find out. So, of course, I'm not saying that's foolproof, because never take investment advice from AI, and don't take investment advice from me either. But this isn't investment advice. But I do think that AI has opened up the ability for things which were formerly rather opaque. And I think a lot of what's going on in this space can be somewhat opaque, and not fully understandable, because it's not just profit driven only. It also is profit driven, but not fully profit driven. Some of it is also driven by people wanting to make a difference. Therefore, to be able to understand exactly what's going on and it's legit, I think lean into AI to help you with that. And then to the degree which you can find other experts who understand it, then definitely do that. The other thing you want to look at is, in these offerings, who is involved with it, right? So some of the people who are involved with it, that's also very important. So if there are people who are credible in this space are involved with it, then that's going to be an indicator as well that it's more likely to be legit. But definitely, especially in this space, do your due diligence.
Greatly appreciated that. So the next question is going to be for Jackie, and it's going to be very similar to that. And there are certainly ESG markers out there. People talk about the impact. Do you feel like those ESG markers are too broad? And what are some solutions for us to really drill down into climate change, and look at some measurements that really make sense and really prove what the impact of these businesses and the investments are moving forward, because this is such an existential threat?
Yeah, I don't know if everybody knows what that is. ESG stands for environmental, social, and governance. It's basically a broad set of non-financial factors that investors use to assess risk and long-term performance. It's important to say clearly, when we say ESG, it doesn't necessarily mean directly climate. Climate tends to be more in the E section, the environmental. And most ESG scores are produced by, first of all, they're in the big public markets. They are for large organizations like an IBM or a Microsoft and they attribute to their entire business. So you can imagine, that ESG score is taking in, it's very complex. The scores also are done by third parties. And those third parties, well-known names are MSCI, S&P, Moody's, and those folks are, they each are pulling together the data in order to come up with the underlying scoring for each company. And let's be clear, they're going to rely on company disclosures, which we all know there is no regulation around, requiring ESG disclosures at this point, and no standardization. Sometimes they do questionnaires, they listen to the news, they do a whole variety of things, and then they model the data, and then they use AI to fill in gaps. Each of them do it themselves, and let's face it, the data is incomplete and it can be inconsistent. And that's why actually you can look at the same organization and the big different third parties may have a completely different score for them. So let's start with, it's kind of a crazy world out there. And what's happened is most organizations, and we're talking, when we start to say ESG, we're talking about big institutions in the public markets generally, they've actually started to develop their own internal ESG teams and scoring and things like that. And I guess, and at the end of the day, it's all on imperfect data and it's all on subjective frameworks, even at the very big level. So everything has to be taken with a certain amount of a grain of salt. And just a little side note, if you don't mind. So how did I get into being, co-founding a crowdfunding platform focused on getting private capital moving directly into climate? And it really started on my journey. My last role before co-founding Raise Green was at Goldman Sachs, where I had been, the function I had at that time was in compliance, overseeing trading for private wealth clients. And I grew up in the large banks, trading floors, 25 years. And while I was there, I had the opportunity to the desks, this was the mid 2010s, were working on creating their ESG strategies because there was huge demand from private wealth. They wanted to invest and see some impact. And I had to, because my function at the time was compliance. So I had to dig in and say, what's the data? How often is it clean? How often is it updated? What are the sources? All these kinds of things. And what I saw in that journey was, my gosh, there's a lot of holes in this. It's limited, it's stale. And meanwhile, my personal passion for climate and what I felt we needed to address ASAP, I basically made a decision and said, you know what, I'm going to take my many years of experience and I am going to figure out how do I make sure that private capital can go directly into climate, and where I feel like, it's a pretty sure thing that we know that it's going in and it's going to impact. So with that, I went on the journey, and I actually looked at joining S&P, MSCI, ISS to actually work on the ratings, and then also to go and explain that to the investor community. So that was my thought originally, and I just decided, you know what, when the Raise Green co-founding opportunity came up, I'm going to go do that, and that brings me to why I think crowdfunding is so important here. And that is because, even in the private market space, just generally, there's less data, there's more intermediaries, you're investing in funds and things like that. But when you get down to the crowdfunding space, you're investing directly into a small organization. You're not at IBM, which has a lot of different complexities. It is a company that's building a new battery. I think Brian just shared some of the big companies that raise capital this year in the climate space. You are looking at a company, you have to look at each organization individually, but you are looking at it and saying, what is this company working on? What are they doing? And because these companies are generally so early on, it is, the question of where in the pocket of the organization is this really a climate-oriented investment? It is a little bit more self-evident. Also, the regulations require, so you're going into a small organization. It's typically not that complex, and it may be a specifically designed project. And then it also, by the regulation, it has to identify where the use of proceeds going, and certain disclosures around that. Now, and what is really unique about crowdfunding is that you as an investor, if you are, and of course, Levy is correct, do your due diligence, AI, and Devin has actually a great template for doing due diligence on an offering. Folks should reach out to him on that he's been working on. But the other thing is, you as an investor have direct access to the company. Now, that does not happen as a general matter when you're investing into private companies at a bigger level, or certainly in the public markets. That is really unique. You can go directly to the company and say, hey, tell me about this. Where's your impact going to be here? Et cetera, et cetera. And similarly, if you're investing in a project, you can reach out, you have direct access to the developer that's raising that capital. And really, that is something super unique about crowdfunding. Now, to be clear, there's no impact specific reporting that's required post the raise. That's a universal problem. However, this is a relatively new regulation. And if the market is going to demand it, we're going to be able to potentially get more information post-raise. And certainly as a direct investor into that organization, you can reach out to the company as well directly. So, when all is said and done, so ESG, it is, the concept, the data, it's a problem still throughout the system. It's getting better. But the wonderful thing about Reg CF is that we are really, really down at the company level, at the project level, and you have direct access to the issuers. Of course, never invest in something. These are risky investments. These are, this is crowdfunding. It's always speculative. And so do your due diligence. This is not a recommendation. Thank you.
Thank you, Jackie. Greatly appreciate that. Want to turn to Johnny now. And we want to talk about this ownership economy, which investment crowdfunding has really opened up, especially here in the United States, but even globally. Can you talk a little bit about, Wefunder and what you do with Wefunder and how you are creating an army of advocates for the businesses that they are investing in, especially in the climate space, in the climate space?
Yeah, so I think we would all probably agree that's a benefit of investment crowdfunding, right? Is recruiting an army of investors who can be sometimes customers or sometimes supporters. The B2C company, I think there's probably, usually the most upside to that, but also for B2B companies, these people can help by making connections or helping with hiring or, getting kind of a marketing announcement out on their social media or whatever you want their help with. We launched a new feature on Wefunder recently called Directory, where a company, you can view all the investors in that company. And then after an investor makes an investment in the company, we ask them, how would you like to, are there ways you can contribute to this company to help this founder? And so those kind of offers, if you want to call them that, are listed on that directory page. So yeah, that's really a vision that we have, probably shared by everyone on this panel, is that this is not just capital, right? When a VC invests in a startup, they're taking a board seat, they're kind of adding value and hopefully in real ways. And same is true if you have 1,000 people investing in your company, then hopefully that's 1,000 people who can now help your company win and grow and succeed. So yeah, that's a huge reason I think why founders are looking at raising capital via Reg CF, Reg A+, to complement more conventional institutional accredited investors.
Yeah, thank you, Johnny. I had another question, but I want to circle back to something that Jackie said, which I think is really important, and it's something that I really focus on, is when we talk about, the reporting after the raise, once the business has started to operate, and that impact isn't necessarily built in there. I'd like each of you to just take a few seconds or minutes to really talk about what that would look like if impact was part of the farm AR, right? What does it look like when starting to put impact in as one of the measurements that we build the companies around, because we're talking about climate change and this is such a threat? Please feel free to jump in where you want to. Does that everybody understand the question that I asked? Yeah, please feel free to jump in.
I mean, I think it's really important that people understand what they're investing in, right? And so when you're doing your due diligence, if impact is part of what you're looking for, then you want to balance that out with the profit, right? So it's important to understand that when you're investing in a Reg CF offering, you're investing in a for-profit business, which is there to also turn a profit. So it's just, so what you want to balance that to, yes, it's a company in the climate space, but I think you want to make sure that it has the ability to also make money, because if it doesn't make money, it's not going to have an impact either. So you just, part of the impact is you want to understand what it's doing, and then you can make that judgment, the degree of the impact it's going to make in the climate space. But I think, this isn't charity. right? This is investing in a company, you're looking for a return. So I would jump in and say that that's really, really important to kind of balance those two out.
Bill, to your question on the annual report, the Form CAR, I'll give maybe an answer that you won't like. I don't know, but for me, I wouldn't add that to the annual report. Like, I think one of the challenges with kind of regulation crowdfunding, even more so with regulation A+, is that the kind of reporting requirements are already quite a lot more than they are for regulation D, let's say. So when a company files a Form C, they've got to do audited financials if they're raising more than 1.235 million. They've got to share those financials publicly, and then also, they have to file an report the April after they raise with updated financials. If you're raising from accredited investors via Reg D, you don't have to do that. And I think one of the big reasons why a lot of companies will not do Reg CF is they don't want that financial information being out in the public domain for their competitors to see. And so I just generally, I'm always kind of thinking about that balance between, kind of reporting information to investors, which is obviously why we have those rules in place for Reg CF retail investors, versus the kind of burden on the founder, and especially additional burden versus other exemptions that are more common. And so, the way I would do it would be to have it be optional and say on Wefunder, so there's the annual report requirement in the rules of regulation crowdfunding. The way I would do it would just be to encourage founders to provide updates to their investors. And then to Levi's point, the companies where impact and ESG considerations are kind of looming larger, maybe in investor motivations, then those founders can emphasize those kind of impact updates and investor updates. We hope the investor updates are much more frequent than the annual report requirement in the law. Also, I hope they're a lot longer and richer, but they can be very bespoke and tailored to the company. And yes, if it's an impact-oriented company, the founder can, by all means, kind of brag about the impact that they're having. So that's how I would suggest that's approach versus kind of adding to the CAR personally.
Yeah, I would agree with Johnny on that one. I think the more just overall paperwork and hoops to jump through for the client, just from an operator's perspective, Reg CF is already a lot. And I think with respect to impact reporting, while it can and should be a plus with respect to the impact these kinds of businesses can have, I think it sets up potentially false expectations if impact doesn't realize, which is the risk of any investment or opportunity or company, right? And so especially if some company puts out really aggressive impact metric projections, that can be hard to grow into. And that may, in a sense, persuade or dissuade an investor to make an investment. And I think generally these things can be hard to track unless, say, for example, you have attribution all the way down to, say, the hardware of a solar project to be able to export that power production data from the actual physical hardware. Then it can be very hard to say, hey, this amount of clean energy was generated. And then even from that, there are an immense amount of other assumptions that surround it. What utility is it operating in? What other energy resources are in that grid? It can be very hard to give specific attribution to say what clean or dirty energy it is displacing within the energy system. And so impact metrics are, in a sense, can be very qualitative and not necessarily as quantitative as we might hope. And so promising investors some degree of impact, I think, can potentially create risk for over-promising and under-delivering. When there is something that is a hard quantification, like, for example, on Climatize, a certain project is 16, this is a portfolio of X number of EV charging stations, or the system that is permitted is exactly this big, and that's their execution plan and what is permitted and engineered. I think those are things that can and should be disclosed or explained in the Form C, and look into that in detail. But saying, oh, X number of people were helped, it can be room for calculation error, and therefore I don't think that it's something that should be like permanently reported to the SEC because it creates room for error.
Thank you, Will.
If I may, just couple cents on my end. I totally support what Will and Johnny just said, because I think there is no like objective measure or KPI which can be requested, and even if we try to define something which is compulsory to include in those reportings, we'll end up with additional bureaucracy which will sort of fake those KPIs or other measures, and it will not really show real impact. So if we want to see, in every case, this impact will be different. It is, of course, important for any investor to see impact for every crowdfunding project, because it's not always about money. It's about seeing what your money does. But to make it compulsory, it will just create a bureaucratic loophole, I think.
Yeah, actually, my whole conversation before was about why ESG on the institutional level is problematic. However, I also do appreciate the fact that, if you do invest in something, it would be nice to see, well, did it get built? Something along the lines of my dollars went in and something happened. However, that opens, because there is no exact standard, and everybody will do it differently, et cetera. It does open it up to risk, and it is definitely something that should not be part of a Form C or an annual report, in terms of, one should be very careful about that. It's not required by the SEC, and should really be on a project by project based on the company's own interest. However, whatever assumptions, if they're going to do something like that, any assumptions that are included must be disclosed clearly. So people can, when they look at whatever that impact number is, they can have some sense of, where it may be weak and where it may be strong.
Yeah, just building on what
Thank you.
Jackie said in terms of updates about if a project got built or not. I think one thing that we did at Climatize is we actually visited a number of the projects that had been funded through the platform and interviewed those families, and then essentially built the stories and the narratives that I think is something that's uniquely accessible through climate change, through crowdfunding, is that you can actually see the end beneficiary of your investment, and that's something that you don't necessarily get, like to Jackie's point, through investing in an ESG type ETF or so.
Mm-hmm.
Exactly. So, to Johnny's point, we went to rural Tennessee and interviewed these families and, showed them, or showed the investors, here are the updates of, what the projects actually materialized into. And from there, I think that was a story we were really proud of.
Yeah. And I want to build on this thing that Johnny had said as well. Will, you remind me, and that is, how the investors, it's hard to describe to folks who aren't familiar with crowdfunding, is like how unique the crowd investor is. I mean, this is a yes, they're investing for a return, but it has a whole other component to it, which is because this is personal, and they're making personal decisions. And it's very close to where the action is happening, and they care. And we had one of the companies that raised capital. They do stormwater retention, small woman-owned business, and when the change in administration, stormwater credits being pulled, all these kinds of things happening, and she wonderfully, would keep her investors up to date every quarter, let them know. And she basically said, this is where I am, I'm having trouble. She told me, and she was a doubter about crowdfunding originally. It was a small raise. She had 35 investors, people who didn't know her. which she said first was a great boost for her, just to say people believe in me. And then she said offers came from all over the place to help her, which ultimately got her to an amazing grant that substantial for her business, turned things around even through this, difficult situation. So this is just such a unique environment. And I just think it's critical to the ecosystem of, what we need to do, boots on the ground for climate.
Thank you. That was a great discussion. So for our final question, and you can take this in the order you like to, can the crowd move fast enough to fill this gap, in the climate situation that we have?
Well, we're not going to the crowd isn't going to fill the big gap. Because we got trillions. But I'll start this off and I'm like, yeah. I mean, the wonderful thing about Reg CF, it can move pretty quickly. Looks like thanks to the CFPA and other work that we may get a boost here up to 250 or higher, so that reviewed financials aren't required. And that's going to be substantial, particularly for projects, community scale projects early on, in order to move fast. We're funding portals. We're experts in this. We know how to get an issuer from here on the platform compliantly, relatively quickly with relatively low lift on their part. So, and as we're talking about with the crowd, it's a different analysis. Again, always want to go back to Levy's point, and that investors need to do their due diligence. This is a financial investment. However, crowdfunding, it's all online. It's relatively easy to get up on the platform. Once you do your analysis, investing is relatively simple. I think this can move pretty fast.
Will?
I have to come off mute here. Yeah, so I mean, we have found, in particular, crowdfunding to be very catalytic to early stage project development, and that in turn catalyzes much larger capital deployment into projects, and that's been an area in which we have found a way to really support our clients. And so I think coupled with the institutional capital markets, I don't think that we should look at them as wholly separate. Rather, one can enable the other and actually present a way in which capital can have kind of a levering effect where, $1 at the kind of crowd level can result in $10 of larger capital project finance that takes on opportunities and really takes that the distance. And so that, I think, is a way that we should be thinking about them, rather than this ecosystem has to grow and scale and one-to-one compete. Rather, how one actually feeds and enables the other to actually move faster, because I don't think that we want to necessarily think of these as mutually exclusive. To the extent that one can enable the other, then we can move that much faster and achieve the necessary carbon reductions that we need to mitigate the worst of climate change.
Yep. And that comes to the uniqueness of the crowd.
Just to say, depends who you're talking to, right? If you're talking to the investor, then yes, the investor should definitely look at these opportunities. If you're looking to the issuer who's looking at their project, it's really important that the issuer understands who their investors are. Because what I've seen is, the crowd isn't one thing, it's your crowd. Okay? You have to know who you're investing to in your crowd. They don't just, there aren't just people out there just going to necessarily show up unless you've built some credibility and you know who your investor is and you're somehow able to market to your investor. So it doesn't just fill the gap. Crowdfunding isn't this thing, which is this magic thing you turn on the spigot and investors come and throw money into your deal. And I know that's probably saying the obvious for everyone who's on this on this panel, but other people might not realize that. So that you still have to do the hard work to make sure that you know who your investor is and you're marketing to your investor, and then perhaps it can fill in a gap of your finances that you need to get the project done.
All right, thanks.
I like Yeah, I'll be quick because I think we are running out of time. But in general, I think that there is still a big potential for crowdfunding in general to grow much bigger than it is right now, and there is big potential in terms of the market size. And of course, the share within crowdfunding, there will be a significant share dedicated to climate solutions, green energy, and so forth. So maybe, like previous speaker said, we will not fill the whole gap, but this kind of industry will help.
All right, thanks. Johnny.
Yeah, I mean, as Brian was saying earlier, I think, crowdfunding is still relatively new. It had been growing. It's been a little flat the last few years. It's actually been growing, but I do think that it can play a role. And I'm optimistic about the size of the role that it can play. That's why I've been working at Wefunder for 8 years. I do think the growth is too slow right now. So if the current growth rate continues, the dent that we're going to be able to make is small. So we're constantly trying to think of, okay, how can we accelerate the growth rate here so that we can have a bigger impact? But certainly it can make a dent. The question is how big of a dent against this huge problem of climate change that we're discussing here.
Okay, one of the things that we're working at the Community Finance Academy is engaging with people who are already activists at some level, social justice, climate, and introducing them to what the possibilities of Reg CF, of Reg A, and how we can bring them into what we like to talk about and call financial activism.
I think that's brilliant. I think that's a brilliant strategy. I think the best community rounds on Wefunder, we like the term community round instead of crowdfunding, but that's just us. But yeah, for me, the best Wefunder raises, the best community rounds are where there's just super passionate people investing, like a cause they really care about. Maybe it's a disease that they had a loved one, affected by. Or themselves affected by. So yeah, I think that's a really cool way to do it. It's not kind of having a company and then going to find investors. It's having activists and then turning them on as investors to kind of engineering that's doing the work. I think that's a really cool flip of the approach, Bill. Love
it. Go ahead, Jackie.
I was just going to say, to build on that, get those community folks to bring the project or bring the, they're in the communities. They know where things are happening and what's going on. Train them in Reg CF and have them, bring whatever is going on in their community to the funding portal. We'll see if we can whip up a deal for them.
Thank you. Thanks to the whole.
Hey guys, what a great conversation. Bill, thank you so much for leading a powerful conversation. It was clearly very engaging. We've got people making comments, etc. And so it's really phenomenal to see that. I thank you very much for the energy you're bringing. We've got to take a quick break, but thank you so much, all of you, for being here. Every one of you shared powerful insights. I want to encourage you to go hop into the backstage area. That's a powerful opportunity for you to do some networking and make some connections. And I know there are people waiting for you in there. They want to talk to you. So I encourage you to pop in, even if only for a few minutes. Of course, I want to remind everyone to join the drawing for a free VIP upgrade, and you'll also have a chance to win a $250 investment in one of our live pitch companies you'll see this afternoon. You'll get to pick which one. So this is a huge opportunity for you. In any case, we're going to take a quick break, but thank you so much, all of you guys, for a great panel discussion.